there's tremendous risk at Rivian. Most of our clients miss Tesla, frankly. We freely admit where we're wrong, and wrong a lot, right sometimes, lucky sometimes. I'd say we'd have to see evidence that something like an Apple car or Tesla's industrialization and reinvention of manufacturing puts Rivian in a place where their technologies, whether they're automaking or their battery technology, is obsolete. If we can get to that point, then Rivian would be a great risk. You know, D, we think Tesla's the stock that you have to own if you're building an EV portfolio.
In this video, Morgan Stanley analyst Adam Jonas admits Rivian stock is high risk and doesn't even realize it, says that every investor should own Tesla stock, no shit Sherlock, discusses how screwed legacy automotive manufacturers are, and discusses one strategy that may allow some of these companies to survive. Well, sort of. So, let's get into the video. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support.
It's hard not to start with your Rivian note. We talked about it so much. I wonder if you can sort of tell us how you came to decide that you would call this company the one.
So, I mean, we think it's the one. Most of our clients miss Tesla, frankly.
If most of Morgan Stanley's clients missed Tesla stock, then this implies that Morgan Stanley themselves and their advice on Tesla stock was way off the mark. I wonder how this could possibly have happened. I don't know how, but I've somehow ended up on a Yahoo Finance article from about 2.5 years ago, May 2019. Quote, Morgan Stanley explains how Tesla could become a $10 stock, by the way. This was before Tesla stock split. Split adjusted, this is a $2 stock. Does anyone get the feeling that this scared some of Morgan Stanley's clients away from Tesla stock? Let me know what you guys think below. Let's read a little bit of this article just for some context. Tesla stock has dropped about 38% this year amid lower than expected vehicle deliveries. Cash burn concerns, and a crash reportedly related to the company's autopilot feature. This could just be the start of the stock's declines, according to one analyst. Morgan Stanley analyst Adam Jonas cut his bear case outlook scenario on Tesla stock from $97, remember this is pre-split, so divide all of these numbers by 5, to $10, aka $2, in a note published Tuesday. This worst case scenario would represent about a 95% decline from Monday's closing price of $205.36 per share, which split adjusted is just over $40 per share. And remember, May 2019, not that long ago. By Jonas's reckoning, Tesla's stock price is driven by demand for its products, cash flow generation, and access to capital markets. And none of these factors has been particularly strong of late. Quote, this year's sharp deceleration in demand, what Adam? What? Has led to a substantial curtailment of the company's ability to self-fund through free cash flow generation, at the margin potentially impacting the firm's access to capital. Tesla's recent $2.7 billion equity and convertible debt raise may provide an extra year of liquidity to run a business of this size and cash consumption. Tesla may have oversaturated the retail market. Okay. Tesla may have oversaturated the retail market for battery electric vehicles outside of China, Jonas added, and would need to aggressively expand into the Chinese domestic market, lower priced SUVs, and logistics and mobility fleets in order to generate new demand, Jonas said. Jonas's base case price target for Tesla is $230 per share. He rates the stock as equal weight. And again, just converting that base case price target in May 2019, split adjusted, $46 per share. And since a lot of people have a short memory, I just want to point this out as well. Jonas isn't the only analyst who has recently become less optimistic about Tesla's stock. Wedbush analyst Dan Bandwagon Ives cut his price target to $230 from $275 per share on Monday, citing, quote, continued concerns about Tesla's ability to balance this perfect storm of softer demand. Oh, what the fuck, guys. And profitability concerns. Oh, Jesus. Which will weigh on shares until Musk & Co. prove otherwise in terms of delivering solid results over the coming quarters. Now, I don't want to be too much of a douche here, but I do want to give you guys some context. What I was personally doing in 2019, leading up to and in the wake of these comments from Adam Jonas and Dan Ives. It seems that both of these stock analysts were unable to see what was obviously just around the corner. Tesla printing enormous amounts of money, continuing to run away with the electric vehicle market, and cementing a truly dominant and unassailable lead. So while these guys were concerned about profitability, legitimately believed that there was a slowdown in demand for electric vehicles, and admittedly had some semi-legitimate concerns about raising capital depending on the share price, here's what I was doing. Buying on the 5th of May, the 18th of May, the 4th of April, the 22nd of April, the 23rd, 24th, 25th, 26th, 20th of May, 31st of May, 31st of May, total money in just over $50,000 US. Remember, these are split adjusted prices, multiply them by 5 for what I was paying, picking up a total of 1,000 shares of Tesla stock. Oh wow. Perfectly round number. In March, April, May, in the lead up to these comments, while these analysts were concerned about Tesla, the valuation, demand, etc., I'm loading up and buying 1,000 shares of Tesla because I think it's a dirt cheap bargain. Value gain on those since, somewhere between 1,700% and 2,600%. Reasonable. So it's really difficult for me to understand how some of Morgan Stanley clients might have missed the opportunity in Tesla stock, particularly in early to mid 2019. Unless, of course, they were paying attention to their research and being scared by some of their notes, especially the Morgan Stanley $2 bear case. Now, I don't want to be unfair to Adam Jonas of Morgan Stanley because they've been covering Tesla stock for a long time, 10 years. And in the early days, they're actually quite bullish on the company. Then, inexplicably, things started to unravel. As we can see here, Adam Jonas, a relatively competent analyst based on his tip ranks profile, average success rate a little better than a coin toss. Not bad. Average return, almost 15%. Not bad. If we go and look at the Tesla coverage, this is quite interesting. The company has been covering Tesla stock from all the way back in March 2011, initiating with a buy, then a sell, then a bunch of buys in 2012, 13, 14, 15, and partway into 2016. This is where things get weird. After believing Tesla stock was a buy in 2014, 15, and 16 around the $40 per share mark, they suddenly changed their tune. The company continued to execute, Morgan Stanley becoming less bullish. And here's where things get really weird. We can see a ton of hold recommendations, Tesla stock in the 60s, 50s, and here's the really interesting thing. Even under $40 per share, where previously, a number of years ago, they were recommending people buy, they've now pussied out and think people should just be holding Tesla stock. And then it gets really crazy. Recommending people sell Tesla stock around $100 per share, then hold, then sell, then hold, and now suddenly again buy. So to bring things full circle, any guesses as to why most of Morgan Stanley's clients missed out on Tesla stock? The truth is, if they were paying attention to what Morgan Stanley was suggesting investors do with Tesla stock over the last 5 or so years, at best, if they own some, they may have held it for a while and then followed their instructions to sell just before Tesla stock went to the moon and did more than a 10x.
It's hard to be dispassionate when you missed a name, never owned it, and it's done what Tesla's done. And
so what Adam's saying here, a lot of investors emotional, upset by the fact that they missed the opportunity in Tesla stock. And by the way, they haven't missed the opportunity in Tesla stock. In my opinion, we have a very, very, very long way to go. If you don't already have access to my Tesla stock price targets, check out the card in the corner or the link in the description. Sign up to Patreon. All members at all levels get access to my Tesla price targets, bear case, base case, and bull case every year from now all the way until 2031. Adam Jonas's comments about investors feeling they've missed out on the opportunity in Tesla stock, being dispassionate, aka emotional about missing out on the opportunity, is exactly why I keep hammering these price targets home. I'm telling you guys and girls now, everyone who thinks they've missed out on the opportunity in Tesla stock today is going to want to punch themselves repeatedly in the face in 2031. Of course, the point Adam Jonas is getting at here, most of Morgan Stanley's investors missed out on Tesla stock, even though I don't believe they did. And so now Adam Jonas and Morgan Stanley are here to give them the next Tesla, even though it's not really the next Tesla, but hey, it's better than missing out on Tesla again.
So it's the one that most of our clients that miss Tesla can actually not miss. The other reason why we call it the one is there's been attention paid to the relationship with Amazon, which is clearly strategic. But we think that the market might be underestimating just how important it is. I mean, Amazon, through their success, is having a very significant impact on our environment. And we can work with Brian Nowak and our internet team to calculate per day how many thousands of tons of CO2 are emitted from the final mile fleet. And so Rivian no one cares if Amazon puts solar panels on a fulfillment center roof. Amazon wants you to see these friendly, inviting Rivian trucks up and down your suburban street or city street all day long to remind you that they're cleaning the air. And it's very important because the shipping and fulfillment costs go up exponentially over the next 5 or 10 years. And so if Amazon's not part of this solution, then they might be perceived to be part of the problem. And this concentrates very much on Rivian. Very important.
Yeah.
The one.
So I wonder how you would think of Rivian differently if it didn't have the Amazon relationship. And I'm guessing this pushes you to double down on your overall view that EVs are not going to be all roses for legacy OEMs.
Oh, no, we think the EV business is over time going to be balkanized, commoditized. I heard on the program before, Apple has access to the Chinese market. We are under no preconceptions that Western firms will have access to the Chinese mobility market when it becomes a utility, all right? And even Tesla, we think over time will be extracted from that market. There may be ways that can happen that are still positive for Tesla shareholders, but it's pretty walled off in our opinion. So the Amazon relationship is totally fundamental, not just financially as a customer, but it enables them to set out that infrastructure to address the consumer and the commercial market. And they're going to have issues, but to kind of help mitigate some of the issues on service and maintenance and quality that Tesla struggled with earlier in its existence.
Hey, Adam, good morning. What would it take for you to put a sell on Rivian Valuation?
I mean, listen, I could sell on any of my stocks. We try to keep an open mind. We freely admit where we're wrong a lot, right sometimes, lucky sometimes. But I'd say that I'd say we'd have to see evidence that something like an Apple car or Tesla's industrialization and reinvention of manufacturing puts Rivian in a place where their technologies, whether they're automaking or their battery technology, is obsolete. If we can get to that point, then Rivian would be a great risk.
That awkward moment when Morgan Stanley's top automotive analyst admits that Rivian are completely f***ed and doesn't even realize it. Now, I don't want to be too hard on Adam Jonas here. I mean, after all, the guy has admitted, look, sometimes we're right, sometimes we're wrong, sometimes we're just lucky. But the way Jonas has framed this statement is as if Morgan Stanley don't already know that Tesla has an unassailable lead and that no company, Rivian, Lucid, pick your company, will ever catch up to Tesla. Now, why is this? Not only does Tesla have the world's best engineers, not only does Tesla have well in excess of a decade of experience in manufacturing electric vehicles, not only is Tesla producing more electric vehicles than any other company on the planet, not only is Tesla expanding their production capacity faster than any other automotive company on the planet, not only has Tesla locked in supply chain parts, not only has Tesla innovated in manufacturing techniques, invented new materials, new ways to put together vehicles, not only is Tesla moving faster than anybody else, not only does Tesla already have an enormous lead in terms of manufacturing electric vehicles, economies of scale, battery technology, etc., but they are moving faster than anyone else. It's simply not possible to catch up to Tesla. So the point that Adam Jonas makes here, the enormous risk to Rivian and therefore Rivian stock would be if they discover in the future that Rivian can't out Tesla. Well, I'm here to tell you, Adam Jonas and Morgan Stanley, Tesla's lead in manufacturing, in costs, in technology is unassailable, okay? It's literally unassailable. No one's catching up to them. So Jonas highlighting the risk, but unaware that we already know the answer to the question, can Rivian out Tesla? No, no one can. The end. Of course, Morgan Stanley, or maybe we can call them Moron Stanley in this case, are going to need to see evidence. They're going to need to wait for a few years to watch Rivian start ramping technology and then compare. What are their margins compared to Tesla? How many vehicles are they making? What do they cost? What's their technology doing? How many miles of range are they getting out of this size battery pack versus Tesla? Blah, 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 blah. And eventually, after the few years, Morgan Stanley scratch their chin and think, I don't think they're going to be able to catch up to Tesla. Now, this is kind of embarrassing after all. The folks at Morgan Stanley are quite smart, at least academically. But it's just so strange that they can't see what's already evident. Then again, just 2.5 years ago, these Muppets thought that demand for electric vehicles was declining. I think there's a valuable lesson here for stock investors. If you take the wait and see approach, rather than looking at all of the available evidence today, going deep, really gaining a comprehensive understanding, grasping what's going on, and then extrapolating into the future, you are prone to either make enormous investing errors by buying companies that are doomed, or alternatively, missing out on enormous opportunities because you couldn't quite see the evidence right before your very eyes and thinking hurt too much.
So we ask ourselves, Rivian or Tesla, could they end up being the BlackBerry of mobility? I think that's going to come down to Apple and the Apple car, which we can discuss if you want. But I'd say that that's going to take a few years to play out. So,
am I high? Did Adam Jonas just say that Tesla and Rivian could become the BlackBerry of electric vehicles, pending Apple's entrance into the EV market, as if to suggest that Apple could produce a product that's so good that people will stop buying Tesla vehicles? And Rivian, surely the guy just misspoke. He can't possibly have meant that, right? What do you guys think below? Did he have a brain fade there, or did he literally think that there's a possibility that Apple releases an EV and suddenly Tesla gets wrecked?
For now, we're not trying to time it. I know, John, we only have 30% upside to our target of 147. That's not particularly sexy for your audience. We don't really care. We're not trying to time it. We're not trying to time it.
147, I mean, even where it is right now is it's up there, right? Given what they've actually demonstrated that they can do in terms of deliveries and volume, right? So it sounded though to me what you were saying was more about execution than valuation.
Correct, John. Yes, it's a huge market cap. There's no question, and it's clearly the market mechanism. Your audience is clearly getting very good at discounting the future, unlike any other time we've really ever seen in modern markets. But I'm just saying 30 or 40% upside must be seen with the risk. There's tremendous risk at Rivian. I'd say the biggest risk would be supply chain. We think that if they can they'll sell every vehicle they can make if they can make them. And I believe we at Morgan Stanley are the low on the street in terms of their ramp for the next 2 years because of factors outside their control. It's going to be a really challenging time to ramp production of any auto company, particularly a startup.
Supply chain risk is definitely very real for every company. Tesla obviously going to be the least affected by this. Why? Because they had brains, vision, foresight and balls and actually started moving in the direction of EVs years ago, in fact more than a decade ago. So Tesla has a huge advantage. They knew EVs will be the future. They're all in, they've been all in. They've locked in long-term supply contracts for materials, parts, etc. And every company out there knows that Tesla's serious about making EVs at very high volumes. The challenge now is for other companies who haven't built up their EV supply chains and are now trying to negotiate for limited parts, limited materials with many of the same suppliers who are currently in long-term agreements with Tesla. If you're one of these companies and Tesla says, look, we need 10 million of these parts, and then you've got another company, an EV startup or a legacy automotive manufacturer who goes to that same company and says, hey, we think we're going to be making some EVs in the future. Can we get some parts from you guys as well? Meanwhile, Tesla's like, give us everything you fucking got. Who do you think these companies are more likely to be willing to enter supply agreements with? Company that's moving fast at extremely high volumes, scaling like crazy and has a proven track record, or the companies that still don't really have their shit together, aren't producing EVs at scale and have major risks of going bankrupt? Just asking the question.
If Tesla and Rivian could be the BlackBerry of EVs, if say Apple comes out with its own car, where does that leave the legacy automakers? Are you counting them out? And also I find it so interesting that you're putting Rivian and Tesla into the same bucket when I know you're calling it sort of the one, but still very early days, still a ton to prove, especially as you say on the execution side.
You know, Dee, we think Tesla's the stock that you have to own if you're building an EV portfolio. Rivian, we think, is a stock that you want to own and can own.
Well, I agree with Adam Jonas in that owning Tesla stock is a must. For those that don't know, I'm literally all in on Tesla stock. However, I disagree with the idea that you want to own Rivian. I totally understand that some people are willing to take a huge bet, a huge high risk bet on this company. But today the valuation is absolutely fucking insane. There is no question about this. And there is enormous execution risk in front of this company. Buying Tesla stock is investing. Buying Rivian stock is gambling. Nothing wrong with either of these things, but they are not the same. And I don't really think a lot of investors buying Rivian stock are acknowledging this fact. There is huge risk in front of this company. I wish them well and they could be very successful, but there is a mountain to climb and they're still at the base.
But your question, Dee, was on the legacy OEMs. I think that Rivian and its very large market cap and its ability it's raised $25 billion. They're spending more over the next 12 months on EVs than most legacy auto companies in absolute amounts. We think it's going to put enormous pressure on legacy auto to do something. What could that mean? I mean, a lot of my companies, GM and Ford, for example, they have incredible talent, networks, capability, the F-150 franchise. I mean, JC on your program, he's right. It's a gift. It's the golden goose. But what they lack is the currency to attract and retain talent. I'm talking to I'm talking to clients that at the margin, they say, yes, GM and Ford have what it takes, but if it's contaminated, that's words I'm hearing, if it's contaminated by this asbestos-like internal combustion liability, I don't want any part of it. And now they have other things they can invest in, not just Tesla. And so that's kind of forcing the strategic hand, so to speak. I think the next 6 months are going to be fascinating.
Okay, so then what would sort of make you reconsider, like the legacy automakers that's been discussed, in the past, perhaps they need to actually spin off their EV units to attract, things that you say, like talent? Would that be good enough? Do you think that would go far enough and certainly get them perhaps a greater valuation and capital raise to do some of the things you're talking about?
This is a fantastic question, and in my opinion, this is the move. The legacy automotive companies are all going bankrupt. If they're smart, they take action now, the best strategy to move forward to avoid complete and utter annihilation is to spin out their EV companies, new brand, new name, new everything, take the best engineers, the best talent, and let the original legacy automotive company go bankrupt, default on all its loans, and disappear. It's the only way to survive.
You know, Dee, we've written a lot about different strategic moves, and not just limited to spin-offs. That might be overly specific, and we're not aware of anything, but they do have inside the house capability and talent that if investors had a direct access to it, I don't want to speculate, but they had a direct access to it in order to capitalize it, these individual units could be worth more than the entire market cap of, say, a Ford or a GM.
Absolutely agree with Jonas on this point. There's a couple of reasons. One, we know that EVs are the future. Two, the market is giving absurd valuations to any EV startup, even if they're fraudulent companies with fake vaporware trucks and computer renderings and nothing else to show for it. Not naming any names, I'm just saying. So there's that aspect. In addition to that, the market is smart enough at this point in time to know that legacy automotive manufacturers are headed for bankruptcy, the internal combustion engine is dead, and that is actually a negative drag on valuations of the legacy automotive manufacturers. So I think Jonas is right. These companies spin out their EV startup, IPO that company. That EV component, even though it's already currently within these companies, is likely to have a much higher valuation than the entire company currently does.
And they may not want to do that, and there might need to be some force from the outside, Rivian plus other forces, to change the narrative. I'm choosing my words very carefully. Please forgive me.
No, I love watching the wheels.
By the way, did I mention, Carl, the Rivian R1T goes from 0 to 60 in 3 seconds. That's as fast as a Ferrari F8, and it has a kitchen in it.
Now that's licorice mode right there, Adam.
That's a kitchen.
One more.
Just for the record, the kitchen is pretty cool, but it's also an optional add-on, an additional $5,000. I'm not sure the 0 to 60 time with the extra mass, but either way, Adam Jonas, pretty funny point there. Hope you guys and girls have enjoyed this video. Let me know in the comments below if you own Rivian stock, if you're interested, what would be your entry price if you don't currently own it. And I want to wrap up here by pointing out that it really does blow my mind that Morgan Stanley today don't see how far ahead Tesla is in terms of their manufacturing techniques and their technological lead, and that they believe there's a legitimate chance that companies like Rivian could actually catch up to Tesla in terms of manufacturing costs, battery costs, technology costs, etc. And I also find it stunning that there are investors out there today, not just Morgan Stanley's clients, but many retail investors out there today who actually think they've, quote, missed the opportunity in Tesla stock. Once again, I refer you to my Tesla stock price targets over the next 10 years. Check out the card in the corner or the link in the description to join Patreon to gain access, plus a ton of other exclusive content and plenty of perks. I'm telling you guys today, in 2031, all of the investors who today passed up on buying Tesla stock because they thought they'd missed the opportunity are literally going to want to punch themselves in the face repeatedly. Something to think about. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.